Please take a moment to familiarize yourself with our risk disclaimer. Let's go over the basics of trading binary options. Again, if you buy a binary option, you are speculating that the condition will be true at expiration. This means that the underlying will be above the strike price. If you sell a binary option, you are speculating that the condition will be false at expiration. The underlying will be below the strike price. Being able to both buy and sell different strike prices provides you with a unique advantage, as you can profit on volatility as well as direction. For example, if you think that gold will be above 1700 at expiration, you would buy this binary option contract. If you think gold will be below 1700 at expiration, you would sell this binary option contract. To enter a binary option trade, you must put up what is known as collateral. This means that you must put up your maximum loss to enter a binary option trade. With long trades, your collateral is simply the entire premium of the option. This is your maximum potential loss on a long trade if you hold the contract until expiration. With short trades, your collateral is always the difference between 100 and the option's premium. This is your maximum potential loss on a short trade if you hold the contract until expiration. Now let's look at what happens to your trade at expiration. When a binary option contract expires, there will be two outcomes. Either you are correct and make a profit, or you are incorrect and lose your collateral. Profit on a binary options trade is always equal to 100 minus the collateral. If you take a long trade and the underlying asset ends up above the strike price, you'll receive revenue of $100. This makes your net profit on the trade 100 minus the options premium. If you take a short trade and the underlying asset ends up below the strike price at expiration, you will also receive revenue of $100. This makes your net profit equal to the options premium. The collateral and settlement concept on short trades is a bit trickier, so let's use the formula presented in this image to drive the concept home. As you can see, essentially when you are selling a binary option, you're taking in the premium. Since binaries are fully collateralized, you have to put up your max loss to enter a trade, which is $100 minus the premium. If you are correct on a binary options trade, long or short, you will receive $100 at settlement. When you subtract your collateral from that, you will see that you simply pocket the premium when you are correct. This is a bit counterintuitive, but since binaries are fully collateralized, the mechanics are done in such a way. Once you make a few trades, it should become second nature. Essentially, binary options can be looked at as the natural market consensus of all participants or traders. The more likely the event is to occur, the more money traders are willing to pay for the binary option, thus decreasing your return on collateral if you are correct. The higher probability of you winning on a binary options trade, the lower your return on investment will be. And the lower the probability of you winning, the higher your return on investment will be. For example, if you are forecasting a directional move, the bigger the move you forecast, the less collateral you have to put up on your trade to potentially win $100. On the other hand, the smaller the potential move you're forecasting, the more you'll have to put up to win the same $100. One advantage of exchange-traded binary options is that you will not have to wait for the contract to expire before exiting the position. The price of a contract will change based on the likelihood of the condition occurring as time until expiration approaches and the underlying moves in price. This means you could exit a trade early to lock in profits or to limit losses. With exchange-traded binary options, you can formulate various strategies with varying amounts of strike prices. Using one strike price, you are able to do the following. You can speculate on direction. You can speculate on where you think the underlying asset will not go. You can speculate on how much the underlying asset will move in a specific direction. And you can also speculate on economic and political data releases. Using multiple strike prices, you can speculate on volatility, which includes the following. You'll be able to speculate on the underlying remaining within a range. And you can also speculate that the underlying will break out of a price range. The key concept to keep in mind is that these are direction-neutral strategies.
Thank you very much for watching this video on binary options. To learn more, make sure to check out the next video in our video series. To master binary options trading, check out our Master Series. In the Master Series, we delve into specific strategies on the various ways to trade binary options. And to get strategies and trading ideas from seasoned traders, make sure to check out our strategy guide.